Adjustable rate mortgages have always been a really interesting topic in the mortgage business. So people come in to me to get pre-approved, and sometimes the first thing out of their mouth is, I will only take a fixed rate mortgage. I won't even consider an adjustable rate. And I'm like, of course, that's perfectly fine. I'd say probably 99% of my clients take a fixed rate mortgage. It's just the most common. Adjustable rates, I don't know. There's just been, kind of this weird taboo after the market had crashed. People attribute that to adjustable rate mortgages. Remember stories of friends, family members they knew where they couldn't afford their mortgage payment. Adjustable rate mortgages don't always have to be a bad thing though. So for me, first of all, if somebody comes in and they're like, I will only consider a 30-year fixed, I'm not gonna push them into an adjustable rate mortgage. I don't think it's right for everybody, but I think it has a purpose and it's good for some people. So especially right now when we've seen rates go up, it's more common. When rates are 2% or 3%, like why do you even need an adjustable rate mortgage? Because the rate's already crazy low. But right now, if your rate is higher, an adjustable rate mortgage, you can usually get a better interest rate versus a 30-year fixed. So just want to kind of talk about some examples of where an adjustable rate mortgage might actually be a good idea for somebody and then how they work. So one thing that we always see, adjustable rate mortgages are fixed for a certain period of time. There might be some that aren't. I personally don't have any products, and we have a lot of different adjustable rate products here at Guild, but we don't have any that aren't fixed for a certain period of time. So I'll give you an example. There's some that are fixed for the first 5 years on the mortgage. There's some that are fixed for the first 7 years, and there's some that are fixed for the first 10 years. So even though you might say it's fixed for 5 years, it's not like a 5-year loan where you have to pay off your loan in 5 years. Most of them are still based on 30-year payments, but they adjust after a certain period of time. So say you get a 5-1 ARM. Well, your mortgage is fixed for the first 5 years, that's the 5, and then the 1, every 1 year after the first 5, it's going to adjust. We have some that are 7-1 ARMs, fixed for the first 7 years, and then every 1 year after that it adjusts. And then like the 10-year ARMs, fixed for the first 10 years, and then adjusts every year after that. Sometimes you might see like a 5-6, meaning it's fixed for 5 years and then adjusts every 6 months. So those are the most common ones. So a couple things that why it might be a good idea. I have a guy right now that I'm working with, and at first he told me I only want a 30-year fix, but then he started thinking about it. He's like, hey, maybe I should explore an adjustable rate. So I'm always gonna ask, how long are you gonna keep the mortgage? What are your future plans for this house, to really understand that particular client's goals? So this guy, he's gonna retire in Nevada. He's coming from California. So he's gonna move here, and he's gonna move in probably like 4 years. He's gonna sell his house in California. He has a ton of equity. He's gonna put that towards his mortgage here, maybe even pay it off or at least pay it down quite a bit. So he's getting a 7-6 ARM. So his mortgage is gonna be fixed for the first 7 years, but he knows for sure in that first 7 years, he'll sell his house and then he'll pay down the mortgage and he'll be able to refinance. So he's not even expecting it to adjust at all, because during that first 7-year period, he's going to be refinancing it. I have some people that have taken the 10-1 ARMs, where it's fixed for the first 10 years, and they don't even plan on keeping the home for 10 years. Many people don't keep a house for 10 years. So it's like if you knew for sure that maybe you're only going to keep this house for 3 years, but you know your mortgage is fixed for the first 10 years, is that risky? It could be if your plans totally change. We have a lot of military clients in this area, so they have to move every 3 years. So they know, I'm gonna buy a house, 3 years later I'm gonna move. 3 years after that, I'm gonna move. 3 years after that, I'm gonna move. So if they got like a 7-1 ARM and it's fixed for 7 years and they're only gonna keep the house for 3 years, that also might not be a bad idea for them. So never gonna push it on anybody, but it's not always as bad as people might assume, because a lot of times if you get out of it before that fixed rate period, it never adjusts at all and it isn't risky. Me personally, I would take an adjustable rate mortgage depending on what my goals were. If somebody comes to me and they're like, I'm gonna be in this house for 30 years, this is my last house, I'm never moving, I'm not gonna tell them to take an adjustable rate loan. I'm gonna tell them to take a 30-year fix. So it's just really about understanding, how risk averse is the client, first of all. I'm not gonna stress anybody out by pushing them into that product. How long are they gonna keep their home? What are their goals? Are they gonna move? Are they gonna pay it down? Are they gonna sell it? So just getting to know the client, and then we can, kind of look at and make sure that we're picking out the best option for them. So hopefully this maybe makes you a little bit less nervous about adjustable rates. They can be bad, but they're not always bad. But just having the information and working with a loan officer that understands your goals is probably the most important thing.